Every single time you tap your phone to pay for a coffee, you're actually kicking off this massive, invisible financial machine. Welcome to today's Explainer, where we're going to tear down the back-end architecture of digital banking products. We're looking way past those shiny app interfaces to uncover the precise mechanics, the complex systems, and yes, the systemic risks that power modern digital finance.
So, here's our roadmap for today. We'll start by defining what digital banking actually is, explore bank cards and their incentives, unpack the technology behind Tap, Go, and EMV, discuss approval workflows and education, and then finally, tackle digital lending and NPAs.
All right, Section 1, Defining Digital Banking. Let's get our baseline.
Digital banking fundamentally transforms how we interact with our money, mostly by completely decentralizing the institutional framework. Think about it. We aren't just talking about a website that shows your balance. We're talking about the complete end-to-end digitization of traditional services. It shifts to your primary point of contact from a physical brick-and-mortar building to this omnipresent digital network. Millions can move globally without a single physical branch ever being involved.
And this systemic shift completely dissolves traditional geographical and time constraints. The bank's hours are now your hours, with 24/7 access natively built right into the system. Things like instant cross-border transfers, automated bill payments, and real-time expense tracking, well, they aren't just conveniences. They represent a fundamental transfer of control and execution speed directly into the palm of your hand.
Moving right along to Section 2, Bank Cards and Incentives. You probably noticed that banks actively push these digital tools using rewards programs, cashback offers, and travel miles. It's essentially sophisticated behavioral gamification. But here's a really fascinating part. These perks are largely funded by interchange fees. That's the invisible tax that merchants pay on every single swipe. By gamifying your spending and offering a tangible return on your transactions, institutions are using these incentives to ensure their digital products completely cannibalize traditional cash payments. It's brilliant, really. Now, each card type acts as a totally distinct vehicle routing through this digital framework, and they have entirely different settlement and risk profiles. A debit card draws immediate liquidity, settling almost instantly against your deposited funds. A credit card, on the other hand, introduces issuer risk and float times, leveraging complex underwriting to provide a revolving line of capital. And then you have prepaid cards, which create a tightly controlled, closed-loop ecosystem. They all look identical in your wallet, right? But on the back end, their architectural impact on an institution's balance sheet is vastly different.
That brings us to Section 3, Tap, Go, and EMV. Let's look at the tech making this happen.
The future is tap and go. Just a quick reset here, because this really defines the modern consumer banking experience. We have definitively transitioned from a world of physical friction to one of near-instantaneous digital handshakes.
You see, the old magnetic stripe technology was essentially static data. It was basically a cassette tape. Anyone with the right reader could copy the track and clone your card. But EMV, which stands for Europay, MasterCard, and Visa, introduces a microchip that fundamentally alters that dynamic. Every single time you dip or tap an EMV card, the chip generates a dynamic cryptogram. That's a unique, one-time transaction code. Even if a hacker intercepts that specific data packet in transit, it's completely dead and totally useless for any future transactions. It acts as an ever-shifting, invisible shield for your capital.
And the invisible handshake actually making this possible is near-field communication, or NFC. This uses radio frequency identification so your card or your smartphone's digital wallet can communicate securely with a payment terminal. The critical architectural feature here is that short distance, usually just a few centimeters. That proximity requirement literally acts as a physical security layer. It ensures you can't accidentally pay for someone else's groceries 2 aisles over, keeping the transaction incredibly fast but also remarkably secure. Okay, let's pivot to Section 4, Approvals and Customer Education. Behind every sleek card is a fiercely complex back-end workflow. Digital applications trigger automated identity verification through KYC, or Know Your Customer protocols. Algorithms instantly assess creditworthiness by scraping your financial history. What used to be a multi-week bureaucratic slog of paperwork is now frequently compressed into a sub-second algorithmic decision. This allows the physical card to be minted with its EMV chip and dispatched almost immediately. But listen, the most sophisticated encryption on Earth is completely useless if a user willingly texts their PIN to a scammer. Handing over the technology just isn't enough. Education is the necessary bridge to secure adoption.
Financial institutions have a massive mandate to actively educate their users on digital hygiene and how to spot social engineering red flags. Because in a fully digitized financial ecosystem, an educated customer is the ultimate firewall.
Finally, let's look at the bigger picture in Section 5, digital lending and NPAs.
Now, digital lending mirrors those card approval steps we just talked about, but it operates at a much larger automated scale. Alternative data is instantly scraped, cash flows are analyzed by AI, complex risk models run in the background, and massive sums of capital can be deposited directly into a user's account on the exact same day. It's a huge acceleration of liquidity, streamlined to disperse funds at unprecedented velocities.
But that immense speed brings immense systemic risk, specifically in the form of non-performing assets, or NPAs. Simply put, an NPA is a loan that has gone bad, where the borrower has stopped making payments. Because digital platforms allow banks to push out funds at breakneck speeds to a massive volume of users, the risk management algorithms have to be absolutely flawless. If those algorithms miscalculate, a bank's balance sheet can suddenly flood with toxic debt, locking up their capital practically overnight.
Which brings us to our final thought. If algorithms are approving loans in seconds, what happens when those algorithms are wrong? An NPA isn't just a loss for the bank, it's a freeze on liquidity that can cascade through the broader economy, restricting the institution's ability to lend to other businesses. Digital banking has given us unprecedented financial velocity, no doubt about it. But the ultimate question remains, has our risk management truly caught up to our speed? Something to think about. Thanks so much for joining me on this explainer, and I'll catch you next time.